Money is one form of power, but what is more powerful is financial education. This is one of my favorite quotes from the book Rich Dad Poor Dad. Money comes and goes, but if you have the awareness of how it works, you gain power over it and can begin building wealth. A recent survey revealed that only 27% of Indian adults are financially literate. A significant percentage of our population is paying high interest than they have to due to the lack of basic financial knowledge. In most developed countries, financial education is compulsory in schools. But our relationship with money and its management is complicated. Most people in India do not want to participate in the stock market because they don't know how to handle it efficiently. So, developing financial knowledge is important. Now, imagine that you have decided to manage your wealth efficiently by starting equity investing. Before investing in equities, you as an investor must be mindful of the business that you are buying. If you are not, that ignorance is a source of sorrow and can end up losing your hard-earned money in the stock market. Always remember, survival in the long run is the key to riches. For that, you need to identify companies that are fundamentally robust and are available at enticing valuations. Now, the question over here is how to identify such hidden gems in the stock market. PE ratio, also known as price to earnings ratio, is one of the most important ratios that helps a newbie investor to find out fundamentally decent companies at attractive valuations. Hello and welcome. You are watching The Delight of Wisdom with me, Bhavya Neeraj. In today's episode, I will try to explain the PE ratio to you. A precise understanding of this ratio will enable you to master the craft of stock valuation. So let's begin. To understand the PE ratio, we first need to understand the formula for finding the PE ratio, which is PE ratio is equal to market price per share divided by earnings per share. That is, to determine the PE ratio of a company, simply divide the current market price of the company by the earnings per share. For more clarity, let me show the example of Hima's chocolate business. Hima's chocolate manufacturing company is trading at Rs 300. And her EPS for the year is Rs 10. Therefore, Hima's chocolate company's PE ratio is 30. It is how much price an investor is paying for a single rupee of earnings. For instance, if PE is equal to 30, that means for earning Rs 1, an investor is paying Rs 30. Alright. Now, some of you may be wondering why it is important to understand the PE ratio. Let's try to figure out it by taking two companies from the same sector, Dr. Reddy Laboratories and Sun Pharmaceutical Industries from the pharma sector. Both companies are engaged in API manufacturing. For those who don't know, API is active pharmaceutical ingredient. The current market price of Dr. Reddy's is Rs 4,378 and Sun Pharma is available at Rs 955. Friends, please keep in mind that stock prices may vary every day. Alright, now which one is high priced? A person new to the equity market world might think that Dr. Reddy's is more expensive than Sun Pharma. But friends, you know what? It's incorrect. Now you may be wondering why. Because the PE ratio of Sun Pharma is 54.66 and that of Dr. Reddy's is 19.99. For convenience, let it be 54 and 20. Now what does that mean? It means an investor is paying Rs 54 for earning Rs 1 from Sun Pharma. And he is paying a price of 20 rupees for earning Rs 1 from Dr. Reddy's. Now I hope it's clear. Sun Pharma is overvalued than Dr. Reddy's. This is why the PE ratio is important. It helps you to find strong companies at an attractive valuation. So before ending the episode, the key takeaways are: the PE ratio is a metric that relates a company's share price to its earnings per share. If the PE ratio is higher, it implies that a company's stock is overvalued or that investors are anticipating high growth rates in the future. Businesses that have no earnings or that are losing capital do not have a PE ratio because there is nothing to put in the denominator. And more importantly, analysts can use the PE ratio to compare businesses in the same industry or for a single business across a period. Hope you got clarity regarding the PE ratio. If you want me to dive deep into its calculation part, please let me know. Also, if you enjoyed this video, do press the like button and share it with your friends. I will see you in the next episode.